right, we are live. Brian, thank you for joining us today. How are you doing?
Doing good. It's Friday afternoon. We closed a deal last week, which was a heavy lift to say the least. So I'm ready to cruise into the weekend and enjoy what's going to be a very hot weekend in Nashville. But with Father's Day, I've got two little boys, and the beer will be cold, and we'll be doing some grilling out. So it'll be fun.
I love it. Well, first, congratulations on the deal. It's always a fun thing to have happen going right into a holiday here.
Now, I'll tell you, we were originally supposed to close it the first week of April. I had raised $8.2 million of equity, really solid deal in Kansas City with Garmin and Cargill, just great tenants. And we were using CMBS, which is a lot of what we do. And we were just finishing up the paperwork, and then the world went sideways. So we had to get a new lender. I had to backfill about $1.5 million of equity. And the seller was very accommodative, so that was good. But obviously, that was a little give and take. And really proud of my team for getting that thing over the finish line, because it was work. It really was. So
That is awesome. Well, congratulations. I know that COVID has had an impact on a lot of people's businesses, so it's good to hear you guys got that done. But to get us started, why don't you just tell everybody who you are, where you're from, and how you got started in real estate in the first place.
Yeah, absolutely. And thank you again for having me on the show. I really appreciate it. So I'm a New Yorker who married a native Nashvilleian. So we met in college, went to law school, moved here about 15 years ago. My wife's family has a family office here that's been in the commercial real estate private equity world for a long time. So when I joined the family board, I got exposure to some of the funds we were investing in and some of the sponsors and GPs that we were doing co-investment with. Fell in love with the business, wanted to start my own, wanted to be an entrepreneur. So 10 years ago, I launched our first fund. We raised a series of small funds over the course of 5-6 years. We built up a portfolio of about $250 million of commercial real estate in the Midwest and the Southeast. We recapitalized that with an institutional partner. And then 2 years ago, I took a team with me and I launched a pure co-investment syndication platform specifically geared towards individuals, families, independent RIAs, basically taxable investors. And we, like I mentioned, the deal last week was our 6th acquisition. So we only buy multi-tenant office properties. We focus on secondary markets in the Midwest and the Southeast. And I've really, over the course of my career, tried to simplify things. And so we focus on 3 things. Given our product type, we're trying to give investors access to office opportunities that otherwise they wouldn't have exposure to. We try to give them somewhere between a 7 to 10% yield, depending on the asset and the credit profile, as well as the location. And then we really try to focus on the tax benefits of direct real estate ownership. In my experience, a lot of sponsors and GPs who maybe have institutional LPs or are just starting out don't fully grasp the power that accelerated depreciation, cost segregation analysis, structure and return of capital as opposed to dividends. It can be really meaningful to people in their K1. And so oftentimes we can structure things so that you're getting an 8 to 10% yield annually, but your K1 will actually show a loss or a very minimal gain for the first 1 to 3 years. So you can offset gains elsewhere, et cetera. So I have a CPA, public accounting tax controller in-house who helps make sure that we're doing everything we can on that front. And so those are the 3 things that we do. We try to do 4 to 6 acquisitions a year. It really just depends on finding deals that we like, that we find attractive.
I love it. I love it. And actually, me and my partners got into buying mobile home and RV parks just for that tax reason. So a lot to unpack there. I love everything you're doing. So it sounds like, however many years ago, you got married, you kind of married into the industry. You got introduced to commercial real estate through your wife's family. They kind of you know, they put the bug in you. You loved what you saw, and you said, you know what, I got to do this on my own. You jumped out, started your own firm, did 250 million in acquisitions, and since then you've branched out into different syndications, and your main goal is multi-tenant office in secondary markets. It's a lot to sum up, but does that kind of put you in a box?
That's a lot to sum up. We focus on that 10 to 20, $25 million acquisition price. That's the only thing that I would add. And I would also add that I made a ton of mistakes the first time around on every facet of the business. I continue to make mistakes, but hopefully new ones, not repeating old ones. So.
I love it. I love it. Perfect. So, yeah, I want to delve in a little bit more into your business. I mean, it sounds like you got a lot of wisdom to share here. So, you know, you got started. You already had a little bit of a background with being in your wife's business, and then you jumped in. You started doing things on your own. Can you kind of tell us how was that experience? What were the big lessons learned that you just didn't realize going into it, and kind of what have you learned since then?
Yeah, I continue to learn every day as I make mistakes, but I think the most useful thing and the hardest thing when I first got started out was my father-in-law, who is a trauma surgeon, took a company public in the 90s, just a very impressive guy, very intimidating guy, if you don't know him. He was very encouraging of me to start the company. We think of the family partnership as a way for us to either be of service or to be entrepreneurial and create wealth for our own families and generations. So half the family are kind of entrepreneurs, the other half are healthcare folks or teachers, etc. He made 3 introductions for me when I started. And he said, listen, I'm going to make these 3 introductions. You can tell everyone in the world that I'm an investor with you. But that's the extent that I'm going to help you in terms of raising capital. And that was really frustrating at the time because I know that he could pick up the phone and make 10 phone calls and bring in a lot of money, but it taught me the hard way of raising capital through the coffee meetings, the drinks, the lunches, asking for the intros, trying to get the referral, just ground and pound. And that's what I've spent my entire career doing and really started to embrace it. But it was very hard at the beginning because I was expecting a lot more. In terms of mistakes or lessons learned, one of the big ones early on for sure was we were doing some things in Nashville. My partner and I had an idea of what we thought would be cool in terms of real estate deals and investments. And they were fine. We got very lucky because we were in Nashville and experienced this timing of being caught up in this huge growth. But I realized after 2 or 3 years, I was having trouble raising capital. I thought it should have been going quicker. And I kind of pressed pause and I went around to all of my largest investors and my most logical investors, people who I knew should invest with me but weren't for some reason. And instead of me saying, here's this cool shiny object, you should buy it, I actually listened to what they wanted. So I said, if you're going to invest in commercial real estate, what would be the exact return profile? What would the ticket size be? What would the experience be like for you? What would you want ideally if you could just paint a picture? And I really pivoted toward just providing a product that they wanted. And once I started doing that and listening to my logical investor base, I started raising exponentially more capital. And that was a big lesson for me that, if you want to scale the business and grow the business, you don't have to sacrifice your creativity, but I think you need to be realistic with what your audience wants. And my audience, they really wanted office deals because a lot of them had exposure to multifamily, exposure to triple net retail, exposure to self-storage, but they weren't able to get access to office. And they really wanted a quarterly coupon. They just wanted that cash flow. They didn't care how cool the building was or what it looked like necessarily. They wanted that yield. And so I started just trying to find deals that fit the profile. And when I did that, I started clipping 2-3 deals a quarter. and started taking down some bigger deals. So I think that's a big lesson for me. I could delve into a million different things that I've learned, but those are some of the bigger takeaways for sure.
No, I love it. I love it. I mean, that's the thing that kind of rang true for me, and everything that you just said was kind of either you're following your own creativity, your own expression, or you're following kind of what the market wants. Obviously, there's a middle ground there, but it's really difficult to when you're going down a path. You really, you're an entrepreneur. You want to express yourself. You want to build something, and it's hard to pivot and make sure that what you're actually focused on is what people want. Because in the end, that's what we're here for. We're here to provide a service. We're here to give people what they're actually looking for. And so it sounds like that was a hard lesson learned as you went and you started trying to raise capital once you were out on your own there. So I love that story. I want to unpack that a little bit more. Before I do though, so do you guys do like value add, or do you do new construction?
Yeah, so these are all stabilized. You could call them core or core plus. My New York City investors would call them core plus just because they're not as familiar with a Kansas City or a Richmond or a Cincinnati. But if you're located regionally close to one of those places, you'd probably consider these deals core. So typically we're 85% plus occupied day one, with probably a 5+ year weighted average lease term. So nice stability. Oftentimes we see fact patterns where a local group had bought the building originally. So they nail the location because they're local executives or professionals, but they oftentimes put too much leverage on the deal and they don't manage it as a professional asset manager would manage it. So oftentimes we're coming in and just right-sizing it in terms of lease rate, occupancy, and credit. But no, these are day one cash flow properties.
Great. I love it. So, I mean, you mentioned it multiple times. One of the most difficult parts about your business is raising capital. So, if there's a lot of people out there, maybe not in, office buildings, but in multifamily, in other types of commercial assets who are, they're struggling to raise capital themselves. So if you could give kind of bullet point, maybe top 3 pieces of advice for people who are looking to raise capital, what would those pieces of advice be?
Yeah. And one of the reasons we chose office as an asset class was exactly that reason. We looked at on the landscape, this is 10+ years ago, and even then, multifamily seemed like it was really competitive. Cap rates were tough, deal flow was difficult, and office just had less competition within our price range. So I think it's a great question because you have to face the reality that this is a capital intensive business, and it's going to be very difficult for you to scale it efficiently if you're providing all that capital. It's just, you don't have the liquidity, right? Oftentimes you're trying to create wealth. So one of the things that I learned very early on was having a very frank conversation with every third-party service provider that you work with. When I got into the business, I got introduced to, P&C insurance folks, lawyers, et cetera. And all of them talked a big talk about, oh, I'd love to introduce you to my friends, or my buddy would like to look at this deal, et cetera. And they never came through. And so I've started having very frank conversations of, unless you're providing a specific niche esoteric service, like my securities attorney, for instance, if you're only going to provide that workflow, it's largely commoditized. So I need more from you. And I'm not saying that you yourself have to invest, but you need to be able to introduce me to folks that do want to invest. You need to be actively making introductions and referrals and being a resource for me beyond just the work itself. And so I would encourage a lot of sponsors out there to reevaluate every third party they're working with. Unless it's mission critical and you don't think you can get that work anywhere else, you should shop it. That'd be my advice.
I love it. I love it. And I mean, that's true pretty much in anything you do in real estate. I got started, I'm definitely not as seasoned as you are, but I've got started in single family and multifamily, and now mobile home parks and RV parks, and shopping around, even for contractors, is one of the biggest things you can do for yourself, because it really does. I mean, it matters. You gotta find the right person for the job, and that's definitely a bonus for you. So we should have asked this in the beginning, but why office buildings? I mean, there's tons of different types of commercial assets. Why did you choose to go office?
Yeah, I found that after talking to a lot of my larger investors, oftentimes individuals or even pretty large family offices The only exposure or deal flow they had in terms of office was a Blackstone or a KKR fund of funds or a one-off deal their buddy on the golf course put together. So there really seemed to be a paucity of what I would call middle market sponsors providing accredited investors with office opportunities. And so they were seeing a lot of multifamily deals, seeing a lot of retail deals, triple net, et cetera, but they didn't have exposure to office. And I think it's a misunderstood asset class. A lot of people think tenant improvement dollars and leasing commissions will kill the deal over time. And that's really a function of underwriting. So you have to have enough cash reserves and you have to have the lender relationships to be able to smooth out those distributions over time. And so it was really a function of, I went around to my logical equity sources. They wanted office and there wasn't as much competition within my price range. So it was just more inefficient.
That makes sense. So you saw a market opportunity kind of pop up in front of you. You were like, this is a place I can fit. This is where we can create our company. And you jumped in.
And, you know, we've had to cycle through, we're in 10 markets now. We've had to cycle out of certain markets, right? Nashville, Tampa, Raleigh, they're great. But we've had to kind of move on from them. Office was an asset class where we could still buy new vintage buildings with good credit. And even today, we can buy 7 to 8 to 9 cap deals. And that just doesn't exist in multifamily. The cap rate compression has been tremendous. So, you know, unless you're going to go out on the limb on leverage or, you know, risk, it seemed like a very stable asset class for us where we could find good risk-adjusted returns and still find some pretty valuable deals. Just had to be curious about new markets and get our investors to understand that, listen, you know, Nashville just doesn't have the value it does. So let's go to Kansas City where you can still get some decent pricing. And once you get over that educational hurdle of teaching them about these other places and they gain that comfort, that's what's really allowed us to grow.
I love it. So kind of on that topic, I mean, you mentioned going into different markets. How is it that you decide on a market? I mean, it sounds like you started out in Nashville or maybe New York, one of the two, and then you branched out from there. So what was, kind of take us through the process, the thought process of identifying those markets that you wanted to branch into?
Yeah, originally it was just what can we find and where can we go? So our backyard was Nashville. We did deals there. Then we moved on to Memphis, Birmingham, Louisville, because they were within 3 hours drive and I could go there in a day. We took a step back after that and really started to put together a formula for markets that we wanted to attack. So the way we look at it is secondary markets we define as 1 million plus MSAs outside of the traditional gateway, call it Chicago's, New York's, et cetera. And we look for underlying year-over-year job, wage, and population growth. If those metrics all hit, we go into pricing. You know, what do cap rates look like? What's the cost per square foot? Is there a lot of new construction? Where are lease rates? Can we buy at a discount to replacement cost? We run all those numbers, and then it shakes out to probably 10 some odd markets right now. But specifically, and what I think is really important for multifamily and mobile home, et cetera, it's in many of these markets that are not coastal, there's no geophysical boundaries, right? So if you go to a place like Kansas City, from our assets to the airport, with no traffic, it's literally a 45-minute drive, right? So these places tend to spread. Nashville is the same way. So that's where sub-market analysis is key. You can't just go into a market and carpet bomb it and start buying stuff without understanding the underlying dynamics. Because sub-markets, people where they live, work, and play, it's typically within 20 to 25 minutes, right? I mean, that's probably your experience yourself. Office is no different. So we typically look for 2 submarkets, call it neighborhoods, that never experienced more than 10 to 15% vacancy during the downturn, and that have access to affordable single-family homes, access to education, and kind of that live, work, play, quality of life, cost of living. So once we determine those submarkets, then we go into our price point, which is that $10 to $20 million price point, and we just start, you know, pounding the pavement, looking for deals. So we kind of go top down funnel in terms of how we look at opportunities.
I love it. Yeah. So you're very methodical about it. So you start out, you're looking for MSAs that are 1 million plus, but not in the major metros, like Seattle, Chicago, LA, etc. And then outside of that, you look for year-over-year growth in basically all the different factors that play into the growth of an economy. And then you're looking into the submarkets themselves, distance from the major metro, the location of, it sounds like, different types of assets within that area.
Yeah.
And based on what you find there, you'll pull the trigger on something that's between 10 and 25 million.
Part of our investment thesis is this maturing millennial generation. It's now the largest workforce population in American history. It's roughly 75 million people total. And because of 2008, the family formation phase of their generation, I'm barely a millennial, was delayed 5 or 10 years, but it's coming. So as this generation starts to have children, get married, they're increasingly making choices about where they want to live, work, and play based on quality of life, cost of living, the ability to afford a single family home, and the ability to send their children to a great public school or a very competitive private school. And so part of that thesis is these secondary markets are going to experience dramatic growth. Interestingly, I think COVID is accelerating that trend, and you're seeing more and more news stories come out that, San Francisco, for instance, multifamily is kind of having a hard time. Obviously, we all know about New York. And I personally think a lot of folks are going to look to the suburbs in secondary markets, which is a trend we already saw playing out. But I think COVID is just exacerbating it and accelerating it in terms of how quickly it happens.
Yep. I've had a number of other commercial guys on here, and they all talk about the move to the suburbs. But I've never heard that thesis about millennials, kind of their family rearing years have been pushed out 10 to 20 years. That it makes a lot of sense. I am a millennial. I'm kind of in the middle of it. And so, it makes a lot of sense.
Yeah. And when you take a step back and think, many of us don't, when we're younger, we don't want the life that our parents had. And if you think about our parents, my parents are baby boomers, they went through the 60s and the 70s, but for the most part, they end up living pretty much the same places that their parents did. And so I think you're seeing this play out with millennials, where the narrative on Wall Street was they're all going to live in tower deals in New York and eat avocado toast and never have children and never have a house. And that's just not the reality. And so, that was part of our investment thesis. And what we think is once you see that play out on the employee side, you'll see more and more employers try to get ahead of that curve, expand their footprint, because, pre-COVID, attaining and retaining human capital and talent was the biggest challenge that employers had. And so that's not going away anytime soon. And so we think you'll see more and more folks look to relocate to a hub and spoke model where these secondary markets serve as a big office footprint for some of these larger STEM knowledge-based economy users.
Yep, that rings 100% true to everything that I've been reading as well. And I like the avocado toast comment. That's true for millennials. All right, so we do try to keep this to about 25 to 30 minutes, so I am going to move us along a little bit.
Sure.
We've learned a lot about, how you run your business, what you guys are doing. So now I kind of want to go into a little bit about the experiences that you've had. I mean, you started your own business, so you got to have ups and downs. Everybody does. So kind of take us, you've already mentioned it before just a little bit, but, on the roller coaster that is real estate, take us to one of the lower periods and, the best lesson that you've learned from that period.
Yeah. So when I talked about understanding exactly what my investor base wanted and starting to give them that product, we grew too fast. We got too big too quickly. So we started being able to buy an office building every 2 months, every 3 months.
Wow. Jeez.
And so I raised probably $50 million in 3 years, something like that. And it was tremendous. And we were very focused on the deals, and the deals were fine. What I didn't appreciate and what really started to frustrate a lot of my investor base was we were so focused on doing deals and acquiring because we could. We didn't spend the time or the money on the internal infrastructure to handle the volume of investors. And so bookkeeping, accounting, investor relations, business development, it all went by the wayside, and it caught up with us in a big way. And so there was a big backlash amongst my investors, not so much because of performance. And I think that's a key for folks that are trying to get into business. Investors will not begrudge you performance. I mean, they understand they're taking a risk. They understand they're working with somebody, but the experience that they expect and the level of experience that you provide to them is key. And so one of the things that I've done over the last 2 years is completely rework my internal infrastructure. So hiring a controller and paying them, going out and getting a really good controller, right? Somebody with a public accounting, CPA, tax background, paying for Juniper Square, which is a best-in-class investor relations CRM platform. These are expensive things, and they're painful. I was uploading 350, 400 contacts to Juniper, plus historicals. I mean, you can imagine the brain damage.
Right.
But we actually now get compliments from our investors about how great the experience is in terms of access to the portal. And one of the things also I've been doing is just trying to provide a lot of content and be a resource for them outside of just the deals that I'm doing. I'm not trying to go out and get all their AUM. It's not a zero-sum game for me. And so I've started just trying to be more interactive. Hey, if you're looking at an oil and gas deal, if you're looking at a multifamily deal, if you're looking to maybe sell your business, call me, because all I do is network all day for the most part, right? I'm focused on raising capital. So I'm running across really interesting people that may be able to help them. And that completely changed, where I've got 500 some odd investors today, and I rarely get a phone call. They all have my cell phone. They can text me anytime they want. But, with Juniper and some other things that we're doing internally, that was a big mistake and a very painful 6 months. But I think ultimately made me a much better manager and a much better sponsor.
I love it. There's a lot of good lessons learned in there. What I kind of took from it is that you struggled with the balance that always comes with growth. On one side, you just want to grow as fast as you can. On the other side, you need to build out the systems that allow you to grow sustainably. And finding that balance it's definitely a difficult thing. I mean, we're running into that right now. We've got a ton of leads coming in for parks that we could offer on, but we just can't handle the influx of leads. So I like that. And then I also like that you mentioned basically systematizing the communication to make sure that your investors are being made aware of everything that's happening, and they're not kind of being left out in the dust there.
Yeah, we weren't doing anything nefarious, but when you don't communicate clearly with investors, their thought process go to the worst possible options, right?
Yep.
So now we have a completely transparent system where they automatically get monthly financials. They can go into their into their portal, and they can look at historical distributions, historical quarterly management updates, asset level commentary from the property manager. And it's just much simpler. And frankly, we should have been doing it from the beginning, but we didn't know how bad it was until we realized how good it could be, I guess.
Makes sense. All right, we are nearing the end here, but before we go, I want to hear two more pieces of advice from you. One, what is the habit that you feel contributes the most to your success? And two, if you were to go way back in time to the Brian who's just starting out and just give him one sentence piece of advice, what would that be?
Pay for an internal controller. Do not third party your bookkeeping. It's worth the money.
I love it. I love it.
Because we burned through a bunch of third party folks, and I've tried to not skimp, but not get best in class. And it's not worth the money you save at all.
Perfect. Good.
Give K1s early.
What was that?
Give people their K1s early. Don't be the squeaky wheel. And in terms of advice, I think unless there's somebody internal to your organization or the enterprise that is 100% focused on the capital side of the business, if you don't have that person who wakes up every day and thinks about being able to raise equity and find opportunities, you will fail. You cannot outsource that.
I love it. So always
you are the chief sales officer. You are the chief marketing officer. So when somebody comes to me and they want to start a real estate company and they get coffee and talk about, well, first thing I'm going to do is when I raise this capital, I'm going to hire somebody to help me do blah, blah, blah. No, you're not. You will fail.
Relationships are definitely, they have to be kept inside. You can't outsource that ever.
Yeah.
I like it. All right. So, Brian, you've given us so much wisdom. I really appreciate you coming on here. Everybody needs things in return. So if somebody were to bring you something, what would you like to receive?
In terms of how to get in touch with me?
Well, that's one thing, how to get in touch with you, but also, are you looking for investors to invest in your fund?
Oh,
Are you looking
right.
for
Yeah, no, I
vehicles?
appreciate the setup. Yeah, we don't have an offering right now. We are actually looking at a number of deals. We only work with accredited investors. So, if you're interested, we have a very robust content offering on our website. I'm very active on LinkedIn. So if you're just interested in the asset class or want to learn about office or some of the things that we do, reach out. However I can be a resource, I'm happy to.
Perfect. And to get in touch with you, that's through LinkedIn, correct?
LinkedIn or the website, excelsiorgp.com are the two best ways.
All right. Well, again, Brian, I know I can speak for everyone listening and watching. We appreciated you coming on here, sharing your wisdom. And for everybody watching, if you want to get in contact with Brian, his LinkedIn will be in the show notes, or you can go to his website. Sorry, can you say that again, Brian?
excelsiorgp.com.
excelsiorgp.com. And other than that, I look forward to seeing you guys on the next episode.
Thanks, Gabe. I really appreciate it. Everyone have a great weekend out there.
Thank you for joining us on the Real Estate Investing Club. If you've watched this far, I'm sure you've gotten a little bit of value out of this. So we would appreciate it if you hit that thumbs up, share it with your friends or family, whatever it may be. And if you'd like to share or partner with us on a deal, we absolutely love partnering on deals and are always looking for quality projects. Go to www.therealestateinvestingclub.com to get in contact with one of our partners. Otherwise, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode.